Hi guys, it's Stock Curry, and the Fed just released their meeting minutes. In today's video, I'm going to discuss what was in those meeting minutes, how it's going to affect the markets, and how I'm playing it, as well as the other important market news that you need to know. So let's get into it! The Fed released their meeting minutes on Wednesday. Now keep in mind, these are the meeting minutes from the meeting that took place in March, and there were two key takeaways from the meeting minutes. The first is that the Fed plans to shrink the balance sheet by $95 billion per month. What that means is all of the bonds that the Fed has been buying, which has pushed down yield rates or pushed down interest rates, they are now going to sell those bond assets. Now, as the Fed sells the bond assets, that is going to cause interest rates to rise. The majority of what the Fed owns are mortgage bond assets, so we can't expect mortgage interest rates to continue to rise at a rapid pace. Now, $95 billion is the standard amount that the Fed will generally sell off their bond assets at. It's very similar to doing a 0.25% rate hike. It's a standard amount. So 25 basis point rate hike is standard, $95 billion for selling off bond assets is standard. But what's significant about this is just the fact that they do plan to sell bond assets. And it looks like they probably would have started this in March had it not been for the Ukraine war. So definitely it looks like by the May meeting, they will start selling bond assets, and that will cause mortgage interest rates to continue to rise, which will eventually put a downward pressure on the housing market. The second thing the meeting minutes signaled was a faster pace of rate hikes, specifically looking at some half-point increments in the spring and summer. Now, coming out of the March meeting, the Fed had indicated that they were going to do a 25 basis point rate hike at each of their next meetings. But the meeting minutes showed that they were actually looking to do 50 basis point rate hikes, or half a percentage point increases at multiple meetings. And spring and summer, you're essentially looking at around the May meeting and July meeting. So this is pretty significant because it means that we're going to end up at an interest rate that is much higher than what they were saying at the March meeting. The other thing that kind of came out about this is they were actually going to do a half-point basis rate hike at the March meeting, but they ended up holding off and only doing a 25 basis point rate hike because of the war in Ukraine. Had the war in Ukraine not occurred, they would have done a 50 basis point rate hike. So they do still plan to do those 50 basis point rate hikes. They just didn't do it in March, which means most likely it's going to happen in May and again at another meeting later in the summer. So this is going to cause interest rates to rise faster. You combine that with the selling of the bond assets, which is going to cause mortgage interest rates to rise faster. And altogether, it points to the Fed being a lot more hawkish than they have been in the past. It's essentially looking at all of the fears that came out of the January meeting minutes and then putting them into action starting in May. So this overall is really going to cause some downward pressure on any sort of stock that relies upon financing future growth. Financing future growth is generally done in the heaviest way in the technology sector. There's a ton of money that gets put into technology in order to build out certain systems and whatnot. So that ends up causing a bigger negative effect on technology stocks, more so than just about any other stock. And so that ultimately is going to cause a downward pressure on the NASDAQ, and secondarily, more downward pressure on the S&P. The Dow should be relatively unscathed. However, we could still see the Dow come down as the other markets come down as well. And of course, it puts more downward pressure on housing stocks. The other thing that we have to watch out for is not only housing stocks coming down and technology stocks coming down and the markets overall coming down, but we have a few other things in the future where this news could be very temporary, meaning this news could only matter for maybe another week or two. Because coming up towards the end of April, earnings season starts. And no matter what the news is, ultimately, the markets are interested in what are earnings. How profitable are companies? And more importantly, what is their future guidance? So what really makes this earnings season so important, starting at the end of April, is the fact that this is the first time that we're going to get earnings from 2022. And everybody's going to be looking at these earnings. Now, if earnings come out and they're great and companies are beating and they're profitable and they still have the ability to raise prices in order to overcome inflation, then we could see the stock market really go up. However, if the earnings are bad and companies are missing and they're just not able to raise prices to keep up with inflation, we could see the stock market continue to go down, because at that point it's signaling a slowdown in the economy, which will eventually lead to a recession. Now, all of this caused the 10-year Treasury yield to rise to its highest level in 3 years. Now, keep in mind that as bond yields rise, that means people are selling bonds. When people sell bonds, the yields rise. So if people are selling bonds, they now have a lot of extra cash. And keep in mind that the bond market is much larger than the stock market is. Where does all of that cash go? Do you just hold cash as inflation's running up 8% per year? What do you do with it? Well, a lot of times that cash is going to go into other investments. And the only two other investments that people put their money into are real estate and the stock market. That's it. You got real estate, you've got the stock market, you got the bond market. You got to pick one of those three to put your cash into. So if you're pulling money out of bonds, you either got to put it into real estate or put it into stocks. Well, the problem is the real estate market is already sky high. It's very clear there is a bubble, and it's also very clear that housing prices are about to come down. And you don't want to be sticking your money into housing when you know that housing prices are going to come down, because you're just going to lose money. I mean, it would be better just to hold it in cash. So the only other place to put that money is into stocks. And it's this old acronym TINA, T-I-N-A. There is no alternative. You have to put your money into stocks. You don't want to leave it in cash. You'll lose money to inflation. You don't want to put it into bonds because bond prices are dropping. You don't want to put it into real estate because you know real estate prices are about to go down. So stocks, it's the only place to put your money. There is no alternative. And as all of this money comes out of the bond market, as people sell off their bonds, it's going to go into the stock market, which will put more upward pressure on stock prices because there's more buying pressure on the stock market. So even though the news of the Fed tightening is really bad for stocks and will certainly hurt and affect stocks, especially in the NASDAQ and lesser so in the S&P, we could still see prices rise as money comes out of the bond market. And this, by the way, is why very often the stock market will hit new all-time highs as we go into a recession. Because as we go into a recession, bond yields spike, which means prices on bonds just tank. So as we go into a recession, tons of money gets pulled out of the bond market, gets thrown into the stock market, and that's what causes us to reach new all-time highs in the stock market. It's nothing fundamental, it's just we have a ton of money out there with no alternative place to put it. So keep that in mind, that even though Treasury yields are rising, that could actually be good for stocks a little bit down the road. Now, speaking of signs or indications of a recession, we're seeing that mortgage demand is down more than 40% from a year ago. Now, we would expect that a lot in refis, but what we are starting to see, which is actually the indication of an incoming recession, is the fact that mortgage applications to purchase a home fell 3% for the week and were down 9% from the same week a year ago. So as less people buy homes, this is lowering the demand on housing, and as the demand for home purchases goes down, this will eventually lead to a downfall in the pricing of the homes, and as home prices come down, that is what's going to slow down the economy and lead us into a recession. Again, the housing market works very slowly. This takes years to play out. We may not hit that recession until 2023, 2024. In either case, all the money coming out of housing and bonds should push the stock market higher in the meantime. Now, in some good news, President Biden did officially extend the pause in federal student loan payments through August. This is going to free up cash and give more people money to actually go spend things on goods and services and groceries. So it increases buying power, which should help delay at least any sort of recession or downturn in the economy. Now, of course, it's not good for every stock. This is bad for any stock that deals with student loans, such as SoFi. So it's no surprise that SOFI was down 4% on the day and another 6% after hours. Now, in some other news that's a little concerning and could cause the markets to go down, we've already talked about the new Omicron variant, the BA.2. Well, now there's another new variant that has just been discovered in the UK. This variant is called Omicron XE, and over 600 people have had this variant detected in them so far. It turns out this variant is a mix of the original BA1 Omicron and the new BA2 Omicron. Now, this is a brand new variant, so nobody knows how severe it is or how contagious it is. Time will tell, but just another thing that could cause the markets to go down a little bit in the short term. Now, in some other good news, the 10-year, 2-year yield inversion has gone back the other way. Now, this is very significant because if you look in June 1998, the yield curve initially inverted temporarily, but then it didn't reinvert until February of 2000. It took almost 2 years for the yield curve to reinvert, and then it was another year before the economy actually went into a recession. And the same thing happened in 2006. In February 2006, there was a brief inversion, and then it did not reinvert until about June of 2006, about 6 months later. And then the recession actually started in around January of 2008, or about a year and a half after that. So the fact that the yield curve is no longer inverted and is actually rebounding upward could signal that we might not get a recession until later than expected, possibly as late as 2024 or 2025. So this is, again, more good news. So what does all of this mean for the markets? Well, unfortunately, nobody really knows. We have some bad news that's out right now with the Fed being more hawkish and mortgage rates going down. And we also have some good news that's coming out with Biden extending those student loan payments and the yield curve no longer inverted. So it's kind of a mix right now. And I think that was really well reflected in the markets today after the Fed meeting minutes came out. After they came out, if you take a look at this 1 minute chart here on the QQQ, it was an absolute roller coaster. For the first 3 minutes after the Fed meeting minutes came out, the stock market went up. And then it turned around and absolutely tanked. Then it bounced off of the 38.2% Fibonacci retracement line, went on a skyrocket upward, and then stopped, turned around, went back down, then went back up, then went back down. Literally nobody knows. The markets have no clue what direction to go in. And if you look on the daily chart, we have a gap to fill, which is bullish short term, but then we also have the MACD and the RSI dropping, which is bearish. So what happens for the next 2 days is anybody's guess. Thursday and Friday are a complete toss-up. I have no idea what's going to happen. But I do think that after the next 2 days, for the next 2 weeks, I think we're going to see the market go down. I think the news of the Fed becoming more hawkish is going to take over the narrative, and we're going to see stocks drop for the next 2 weeks. But then in the last week of April, when the earnings start coming out, I think the earnings are going to be good, and we're going to see the stock market start going back up again. So that's my prediction. I think Thursday and Friday are a complete guess. I think the next 2 weeks are going to be bearish, and then I think after that, we're going to become bullish again. So we'll have to see what actually happens and plays out, but that's my guess, my prediction. So how am I playing all of this? Well, first of all, since Thursday and Friday are very unknown, I went ahead and closed out the Apple vertical call spreads, which was a bearish play, for a 30% profit. Now, I bought those on Monday, so it was 30% in about 3 days. I also closed out the TSLA credit call spreads, which again was a bearish play, for a 25% profit. Again, these are the Tesla call spreads that I bought on Monday, and then I closed them out today for about a 25% profit over 3 days. So now I'm just holding quite a bit of cash, but I did buy a put option on QQQ, which is that NASDAQ 100 ETF. It's a put option that expires on April 14th. So even though I'm not really sure what's going to happen Thursday and Friday, I think the markets are going to drop enough next week to make that put option profitable. By the way, if you want to know everything I'm buying and selling before the order's even filled, if you want to know when I place the trade, and in many cases before I even place the trade, you can join the VIP Discord. In the VIP Discord, I show all of my trades before they're filled, and I also give my reasoning why I place those trades, so that you can decide if you want to jump in or not as well. And the people who have joined the VIP Discord are absolutely killing it. Rizzy Rack made a 280% profit on his put options, and he thanked me for teaching him how to do vertical spreads. Manny made a 100% profit on their QQQ put. M7 Thurb made a 130% profit on their QQQ put, and an additional 100% profit on their SPY put. Robinhood made a 270% profit on their QQQ put, and Vincat made a $900 profit on their Twitter put. So if you want to get in on these plays and make these profits with us, then come join us at the VIP Discord, where we are profiting day and night. You can join the VIP Discord at stockcurry.vip/getvip. That's stockcurry.vip/getvip. I also wanted to remind you that Webull is offering their best promotion ever this month. They're giving away 5 free stocks worth up to $9,600. All you have to do to take advantage of that is sign up using my link in the description below and deposit just $1 into your account. When you sign up using my link in the description below and deposit just $1, Webull is going to send you 5 free stocks worth up to $9,600. You can take advantage of that promotion at stockcurry.vip/Webull. Now, if you're not a U.S. resident and you want to get in on these option plays with us, you can sign up for Interactive Brokers. Interactive Brokers offers options trading throughout the world, including in the UK. So even if your UK broker does not allow options trading, Interactive Brokers does. That's why it's always a great idea to have multiple brokers. So if you want to trade options with us and you're not a U.S. resident, you can sign up for Interactive Brokers. Again, I have a link for that in the description of this video. And of course, I want to remind you that I do have material connections with both Webull and Interactive Brokers. So whenever you sign up for either one, not only are you getting a great broker to trade with, you're also helping me to continue to produce these great videos for you. Now finally, I just want to remind you guys to hit that like button, subscribe, and click the bell icon and click all so that you can get notified when I release my next video. I hope you have a lot of success trading, and I will see you tomorrow.